welcome to this week's MFB News. Hope things are good with you, all fine here. Was loving the sun on Sunday. Where did it go? But when it was there for the 5 minutes it lasted, wasn't it incredible? Now in terms of what we got for this week, keeping on the sunny theme, we're going to talk a bit about what's happening with swap rates and lender pricing. We're going to go through some lending criteria changes. We're going to touch on house prices and what's been happening there. And then lastly, we're going to talk about how the Trump tariffs, and you would have seen this in the news, are going to potentially impact interest rates going forward, so you guys can potentially get planning. Okay, now first up, swap rates and another more positive week. So 2-year swaps as of last night were just over 4%, so 4.007 for those of you who want to be precise. 1 month ago, 4.223. And 1 year ago, 4.323. So essentially what we can see here is that actually month on month and also year on year, swap rates are lower than they were. 5-year swaps, 3.85 last night, so way under our 4% benchmark that we like to use. Fantastic news. 1 month ago, 4.025. So you can see that month on month we're sort of circa 0.2% down on 5-year swaps. 1 year ago, 3.744. So we are closing that gap in terms of year on year as well. Now the thing that is particularly interesting here, and we talked a bit about this last week, but 5-year swaps at 3.85 and 2-year swaps are literally just over 4%. So there's just a 0.15% difference in terms of 2 and 5-year swap rates now. Whereas in times gone by, they were sitting at sort of 0.6%, 0.7%, around those marks. So what can we read from this? Well, essentially what the capital markets are telling us, that they think that essentially rates over 2 years are going to be almost identical to 5 years. So what we can read into that is actually, sure, there is an expectation that base rate will come down over the next couple of years, but don't forget base rate predictions already built into swap rates. So so what they're essentially saying is actually there's not a huge amount of difference between 2 and 5 year fixed rate predictions going forward. So essentially what they are saying, and I've gone around the houses a bit explaining that to you, is that we're almost reaching a point which could be regarded as being consistent over a 5-year period in terms of mortgage pricing. Okay, so we know that swap rates have been easing their way down, which therefore obviously paves the way for lenders to reduce their rates. Have we seen a gazillion lenders bring their rates down in the last week? No. What we have seen is a round of lenders reduce their pricing last week, and I suspect we'll see more lenders bring their pricing down in the week ahead as well. Why are all lenders not instantly reacting to this? Because actually repricing a whole product set is very, very time consuming for lenders. So just to kind of bore you with the process for a moment. So not only does their treasury have to agree to the new pricing, it has to go through compliance, it will have to go through marketing, it will go through everything that's kind of pushed out within the lender's system. So there's an IT kind of barrier here potentially. Also, a lot of there's things called sourcing systems that mortgage brokers use, where we have access to essentially all the lenders' rates, and we go in and type in some details and it brings up which rates are available for a client. That will all need updating. So actually when a lender reprices a product set, while with the sort of advent of technology, things are a lot easier than it used to be, it's still a really big deal. So lenders don't like repricing rates kind of, regularly. They want to do it as rarely as they possibly can. So some lenders are probably sort of sitting and saying, actually swap rates are going through a bit of a move at the moment. Let's just let things settle down. Then we can look at repricing our product set. So what I'm saying here, reading between the lines, is that actually I think there's more to come. But what we have seen in the last week is, first of all, Accord mortgages make reductions of up to 0.25%. Now, Accord are a vanilla lender. They're part of the Yorkshire Building Society. They have a sister company, which is Yorkshire Bank Commercial Mortgage. I have to think of the name then, sorry. So they're a commercial lender who we use a lot for kind of more complicated buy-to-let transactions and also commercial. But Accord is the very sort of vanilla buy-to-let arm and also residential. So these guys, as you won't be surprised to hear when I use the word vanilla, so no limited companies, no HMOs, no multi-units. They're looking at sort of straightforward deals for landlords with no more than 10 buy-to-let properties in the background. But their rates are very favourable when they're kind of really looking to play. So good to see them bring their pricing down by 1/4%. We're seeing Keystone Property Finance bring rates down by 0.15%. Keystone would be the antithesis of Accord Mortgages. So very specialist lender, very, very good manual underwriting, looking to take a commercial view on deals. So HMOs, multi-units, limited companies, trading limited companies, day one remortgages, all that kind of wonderful stuff. They are able to take a view on very kind of minor or historic credit blips. and they really like to get their teeth stuck into complex transactions. So definitely good to see their rates come down a bit. We've seen the Family Building Society bring their rates down by 0.1. Interesting lender, very, very small, but actually do some really quirky stuff. So things like limited companies, holiday lets, in the residential space, they've got loads of niche stuff as well going on there. So good to see them bring their rates down by 0.1. Now we've also seen rate reductions from Foundation Home Loans, Lambay, Aldermore, the Principality, and also Paragon as well. So lots and lots of pricing movements across mainly specialist lenders, only Accord Mortgages who are classed as non-specialist within that. So as we can see, downward direction of travel, which is all good. More to come, I think, in terms of responses to the swap markets, the capital markets with swap rates. But what the capital markets are telling us with regards to their 2 and 5 year swap rates is that actually the average cost of base rate over 2 years is looking very similar to 5 years. So actually what they're not expecting is, we're not expecting rates to change dramatically once we go through this kind of adjustment that we're seeing just now. Now, just to touch on base rate very, very briefly, because today it is Wednesday morning, crack of worms. You can see it's still dark behind me. I'm so looking forward to the spring when I'm doing this in daylight. Not long to go. But yes, we've got the base rate or the MPC meeting tomorrow on Thursday, the 6th of February. For those of you who watch this on a Wednesday, I'm going to give you some thoughts about what's going to happen. For those of you who watch this after Wednesday, you can tell me whether I was right or wrong. But the expectation is still very much that we're going to see one reduction of 0.25% in the meeting tomorrow. There's lots of reasons for the MPC to not want to reduce their rates, and I think it will be a kind of very balanced vote. But actually, I think there's a lot of pressure on the MPC, excuse me, to bring their rates down as well. And given the latest inflation data that came out, I think that there's going to be they're going to have very little choice. So maybe a reluctant 25 basis point reduction. We're still expecting between 1 and 2 more this year. I think the general kind of sentiment is it's 2, but actually the more kind of cautious pundits are saying it might be just 1. But actually, yeah, so my money is on for a 25 basis point drop on Thursday. We'll catch up next week and we can figure out whether I was right or not. Okay, now our friends at Fleet Mortgages have made some lending criteria changes. And actually, the two things that they've changed both kind of open up the door for some fairly interesting discussion around broader lending policy in the market, which may be impactful for you guys. So here we go. So the first thing Fleet have done is said that they're now accepting TR1s. Now this is to, and I'm quoting here, move us firmly back into day one remortgage space. They're now accepting TR1s to allow them to go to offer with land registry not having to be fully updated until completion. What on earth does this mean? So when you're looking to refinance a property, the lender would expect that land registry will have been updated to show that you own the property. The process of this is that the form that is sent to land registry to facilitate this happening is called a TR1 document. Now what we find is that actually land registry are really, really slow. So they receive the TR1, the land registry database is not instantly updated. It can take months and months and months. So some people who are particularly remortgaging within a relatively short period of time of ownership inside of 6 months, but actually sometimes even longer, are finding that they're getting their mortgage all sorted out, the process has gone across to legals, and then we hit a wall because actually land registry has still not been updated with regards to the change of ownership. Now, what Fleet are essentially saying here is that actually we're happy to progress with the mortgage. Land registry has to be updated for completion, but we can't issue an offer without that being updated. We just need the TR1 to have been submitted. Now, one thing to note, if you are finding this to be a problem, and actually we come across quite a lot of clients that do, just because there are some huge delays at land registry, what we have done for our clients is send a note to the client solicitor saying, we're trying to get a mortgage on behalf of Mr. Jones, but actually because the change in ownership is not showing at land registry, we cannot complete this mortgage. And this is financially disadvantaging our client. And actually this note in itself is enough to expedite the process. So we've had then clients who've come back and said, actually land registry made the change within 5 days on receipt of that note. So just be aware that if you are finding this to be a challenge, this is something that can really help. Now, the other thing that land registry have done is they have reduced their minimum floor requirement for flats down to 30 square metres. Now, the wily ones amongst you will know that actually the vast majority of lenders, when they're lending on studio flats, require the floor area to be at least 30 square metres. So it's great that Fleet have actually brought their requirement on studios down to that. But actually Fleet are not just saying studios, it's all flats. So some lenders would say that actually if it's a flat, a 1-bedroom flat or more bedrooms, we would expect the floor area to be even bigger than 30 square metres. Fleet is saying, actually, don't worry, as long as for a flat there is a 30 square metre footprint, then we are good to lend. So there you go, a couple of actually what we'll see fairly innocuous changes from Fleet, but actually in terms of the broader market, very, very interesting. We haven't talked about house prices for a while, have we? I remember I was talking about them every single week for a while. So look, what's happened with house prices? So house prices in the UK rose by 0.1%, and that's according to new data from the Nationwide, which is incidentally a lower rate of increase than economists had predicted. Most of them were predicting 0.3% growth. So in January, your properties would be worth circa 0.1% more than they were in December. So the average house price in the UK is now £269,426, and the annual rate of increase is now 4.1%. So year on year, so in December, we were at 4.7% growth. We're now at 4.1% growth year on year, but we are still in a growth territory. Now, the commentary that sits around this is quite interesting, so I just wanted to share it with you. So what I've kind of seen is that admittedly sticky borrowing costs and changes to the stamp duty relief outlined in the October budget represent downside risks to house price inflation in 2025, i.e. these could drag down house price growth. The swap curve has been volatile since the budget and the election of Mr. Trump in the US with market pricing. Don't we know it? The end of the stamp duty threshold relief in April is also causing buyers to rush to complete transactions in the first 3 months of 2025, which will add to price momentum now at the risk of dragging down activity and house price inflation in H2 2025. But these economists are thinking that actually these factors will slow rather than stop house price inflation from rising this year. Therefore, they're predicting a year-on-year growth of 4% in 2025. Excuse me. So what we can read from that is that actually, yes, there are some real headwinds in terms of house prices. There's some factors in there that actually could really slow things down. But the reality is that despite all of that, they're still expecting house price inflation to be at the end of 2025 at 4%. Trump is back in power and making waves and influencing people already, it looks. Who would have expected any less, to be fair? Now, we will have seen in the news lots of chat around the tariffs that he's looking to bring into play. And that does really raise the question, well, how does that impact us? So just to be clear, there's no talk of tariffs being imposed on the UK. We're exempt from that. But actually, fundamentally, it will still have a knock-on impact if they go ahead, particularly the tariffs for China will have a knock-on impact across global economy. So how's that all going to shake out? So essentially, the UK economy will be hit, but indirectly by the effects of the White House policy. Firstly, these tariffs are going to lead to a general slowdown in global trade volumes, which essentially will depress economic growth, particularly for an open economy such as the UK's. So Trump's approach is also expected to push prices up, leading to a temporary resurgence in inflation. Now, if the financial markets do start essentially betting on higher inflation and hence higher interest rates, that's likely to drive up the cost of borrowing in the US, and that in turn has tended to increase the yields on UK government bonds or gilts, which we know all about because we talked about those lots in the last few weeks, because the two markets are closely interlinked. So what does this actually mean for you in kind of layman terms? So essentially, at the moment, I think the markets are just kind of watching because obviously Trump has made these announcements. China has retaliated with their own tariffs. Now there's going to be a meeting between the two presidents. And so let's see how that kind of shakes out in the first instance. But fundamentally, if these tariffs were to come into play, that would slow down movement of goods or trade in goods across the globe. And therefore, this could then essentially cause inflation in the US, which means higher interest rates in the US, which means higher gilt rates in the UK, which therefore impacts swap rates, which would mean higher fixed rate pricing, essentially. So in a nutshell, not a good thing for us, but I think actually at the moment, there's no need to panic. We know with Trump, there's lots and lots of posturing. Actually, there's bound to be a kind of deal that's thrashed out with China. So let's just watch this space and we'll keep you updated. Who knew there was so much exciting stuff to cover off when talking about mortgages? Fascinating subject, isn't it? It always amazes me when I do these videos every single week. And I think we've been doing these for like 3 or 4 years now. We started it in COVID, and every week I think, goodness, what am I going to talk about? And every week there is just so much to say, which I hope you find interesting, by the way. If you have any questions, do give us a call, 0345 345 6788. You can contact us via email. You can go on our live chat system. There's lots and lots of ways to reach us. As an inquiry from the website. I'm sure if you really want to send us a carrier pigeon, we'd be glad to receive that as well. But do get in touch. We'd love to help. Have an amazing week, and I will see you same time next week.